Picture this for a moment. While most people were sleeping, billions of dollars quietly vanished, not from a battlefield, not from a cyber attic, but from one of the most trusted financial hubs in the world. No explosions, no breaking news alerts, loud enough to wake the average saver. Just a silent shift of money, power, and confidence. And here's the uncomfortable truth most banks don't want you thinking about. What just happened in London didn't stay in London. It sent shockwaves straight through Wall Street, and the same forces that caused those losses are now sitting inside your own banking system, waiting for the right moment. If you think your savings are completely safe because your bank logo looks familiar or your app works smoothly, stay with me, because the story you're about to hear changes how you see money forever. Before we go any further, if you want clear.com/no-hype explanations about what's really happening in the global financial system, make sure you like this video and subscribe to the Finance and Global Economy channel. Tea helps more than you think, and it ensures you don't miss what's coming next, because in times like these, information is not entertainment, it's protection. Now let's talk about why Wall Street just lost billions in London, and why that loss matters to you personally. To understand this, you have to forget the idea that financial markets are separate by country. In reality, modern finance is one giant web. New York, London, Frankfurt, Tokyo, these are not isolated cities. They are interconnected pressure points. When one tightens, the others feel it instantly. London is especially important because it sits at the center of global currency, trading, derivatives, and international banking deals. Trillions of dollars flow through London every single day, often without the public even noticing. What happened recently wasn't a single dramatic collapse, it was something more dangerous, a slow, technical unraveling. Several major US financial institutions had massive exposure in London-based markets, particularly in interest rate derivatives, currency swaps, and leveraged bond positions. These are complex instruments, but at their core, they are bets on stability. Bets that interest rates won't move too fast. Bets that liquidity will always be available. Bets that counterparties will always be able to pay. Those bets started going wrong. As inflation stayed stubbornly high and central banks refused to ease quickly, interest rates remained elevated longer than Wall Street expected. That alone is stressful, but the real damage came from volatility. London markets saw sharp, fast price movements in government bonds and currencies. When prices swing too quickly, leveraged positions break. Margin calls are triggered. Suddenly, firms are forced to sell assets not because they want to, but because they must. This is where billions were lost. Large US banks and hedge funds holding positions through London clearing systems were hit with massive margin requirements. Some could cover them, others had to dump assets at the worst possible time. Losses piled up quietly, behind closed doors, recorded as adjustments, re-evaluations, and temporary liquidity issues. But make no mistake, this was real money disappearing. And here's where the story gets personal. Banks don't lose money in isolation. When a major institution takes a hit, it looks for ways to protect itself. It tightens lending. It reduces risk exposure. It quietly changes internal rules. That means fewer loans approved, higher interest rates for consumers, and less flexibility when markets get rough. Even if your bank wasn't directly involved in London, it's connected to banks that were. Risk travels through balance sheets like electricity through wires. You might be thinking, but my bank is well regulated. My deposits are insured. And that's true to a point. Regulations protect against sudden collapse, not slow erosion. Deposit insurance doesn't stop banks from limiting withdrawals, freezing credit lines, or quietly restructuring products to protect themselves first. History shows us this pattern again and again. What makes this moment especially dangerous is timing. Banks are dealing with three pressures at once. High interest rates are crushing older low-yield assets. Commercial real estate values are falling, especially office buildings, and now, international market stress, like what we saw in London, is adding another layer of uncertainty. When stress stacks, systems crack. Wall Street's losses in London revealed something critical. Liquidity is thinner than it looks. Markets function smoothly until they don't. The moment everyone needs cash at the same time, the illusion of safety disappears. That's exactly what London exposed. Too many institutions were leaning on the assumption that they could exit positions easily. They couldn't. And here's the uncomfortable question you need to ask yourself. If large financial institutions misjudged this risk, why are you so confident your local bank has everything under control? Banks today are deeply intertwined with global markets. Your savings account doesn't just sit in a vault. It's part of a balance sheet that interacts with bonds, loans, swaps, and international funding markets. When those markets shake, banks feel it immediately. They just don't advertise it. This is why stories like this matter. Not because they predict doom tomorrow, but because they show fragility today. The financial system isn't collapsing, but it is strained. And strained systems behave unpredictably. Now, let me be very clear. This is not about panic. Panic helps no one. This is about awareness. People who understand what's happening don't rush, they prepare. They diversify, they stay liquid. They pay attention to signals most people ignore. One of those signals is silence. When losses happen quietly, without dramatic headlines, that's often when the smartest money starts moving. Institutions adjust before the public ever realizes why. By the time the story becomes obvious, the damage is already done. The London losses were a warning shot. They showed that global finance is still addicted to leverage, still vulnerable to rate shocks, and still overconfident in its ability to manage risk. And if Wall Street can lose billions in one of the world's most sophisticated markets, no bank is completely immune. So what should you take away from this? First, understand that financial safety today is dynamic, not guaranteed. Second, recognize that global events affect personal finances faster than ever before. And third, stay informed. Channels like Finance and Global Economy exist for one reason: to help you see the bigger picture without fear, hype, or confusion. As we move forward, keep watching how banks behave, not what they say. Watch lending standards, watch credit availability, watch how quickly institutions react to stress abroad. These are the signals that matter. Because what just happened in London wasn't an isolated loss. It was a message. And the people who understand the message early are always in a better position than those who hear about it too late.